Hello and welcome to this episode of The Capitalist Investor. As always, you have me, Diamond Hands D, and we got the whole crew here. Tony the Tiger, Cool Hand Luke. What's going on, guys?
What's up? I'm bringing the energy.
Yeah, there's the energy.
Hey.
Yeah, well, nothing gets me pumped up more than talking about
Small cap
stocks. I mean, let's be honest.
And Treasury yields.
It's the stocks that I can win the most and lose the most. Let's go.
I'm in here, 9 a.m. My hair on fire. Just want to talk to everyone about small caps and the big move that they've made in the last couple of weeks.
Just been a rocket ship.
Yeah,
You've
it really
seen that?
has.
It's literally just been a graph, like a what's it called, right angle, just straight up.
Right. So the reason they're probably up is interest rates, right? And when interest rates are going to come down, that means that borrowing costs should be in line with, I guess like they're going to be able to do a lot more research and development. Cost of money to borrow, because usually a small cap stock is not sometimes a profitable company, so like they have to support debt too with their cash flow. So borrowing costs go down. This is good for small cap stocks. There are whispers that there's 100% 25% basis cut for the Fed in September, and maybe another one after that. So the borrowing costs are coming down, therefore the mid and small caps are reaping the reward, right? And I know that's something that our investment team has been focusing on, because think of last year. The stock market was essentially propped up. 80% of the returns came from 7 stocks? Is that kind of the statistic? Well, one of two things needs to happen this year, right? Everything else, the other 493 stocks need to catch up, or those 7 stocks need to come down. But there usually should be some type of balance, right? And right now the dispersion is immense. So I think we're starting to see a combination of both. The 7 are coming down slightly or just flat, and the other stocks are coming up.
Well, as we're talking, I don't know exactly when this podcast is going to be released. As we're talking, the market is down currently 2%. This might be the Nasdaq's down 2, and the S&P 500 is down 1. This might be one of the biggest drawdowns we've seen so far this year. There hasn't been any kind of big drawdowns. Yeah, Nasdaq's now 2.4%, and the S&P is down over 1. So let me check real quick.
Nvidia's down like 5 and stuff, and the semis are down 4.
The small caps are barely down. Small caps are down 0.3%. So this is the rotation that everyone's talking about. People are selling Nvidia. People are, I tweeted last week. I mean, 4th of July, very thankful. They call up the young buck during holidays on Fox News, and I was talking to Cavuto, and I was like, I think you'll see some, the typical inverse relationship between bonds and interest rates. Like, you're going to see that start playing out because, yields really haven't done anything. And I think that, if we think rate cuts are going to happen, if we think that, possibly weaker inflation data signaling possibly a recession. Like, when yields go down, bond values go up. So you want to rotate outside there. But also, U.S. stocks have been the place to be. Like, the U.S. financial markets have been the place to be. So I think there's going to be a rotation trade outside of U.S. stocks into places like Mexico or India that we own, like those kind of areas. And you're seeing that happen right now over the past week and a half. And that's part of the Trump trade that we've talked about, but it's also part of, when too much money goes to one place, people start taking profits, and then they allocate that money to areas that are undervalued. Small caps being one of them. They were still down 20%, I think, just a few weeks ago. Now they're down 10% from the top, which still 10% from the top, but they've gained 10% in a few weeks. And then you're seeing Mexico ETF rally like 10%. You're seeing India rally another 10%. So the money is truly coming out of the top names, like Tony was saying, and the breadth is widening a little bit. But that doesn't mean that. But what's interesting, I'm late. I've talked about this like 2 years ago or a year ago. I said that you'll see stocks go higher and maybe the indices go lower. I think that's what's happening, because when the top 7 stocks make up 30% of the index, if those 7 stocks drop while the other 70% go up, the S&P 500 and the Nasdaq could actually drop while all the other stocks are making money.
Yep.
But most people would say, "Oh, well, the market's down 10%." Because they own the S&P 500. That's the problem with passive investments, and I think you're seeing it play out.
That's the thing. The active investment side, is where I feel like our investment team brings a great diversifier, a lot against a lot of other advisors where we aren't just piled into the stocks that were, hot money last year.
Yep.
It's a well diversified strategy, and over a long period of time, that strategy will play out. Does it play out in a 6 month period? Maybe not all the time.
Yeah,
right?
play in a 6 month period when 7 stocks go up and carry the whole weight of the S&P, especially when a lot of our clients are in a growth and income, dividend, or value strategy. Then of course it's not going to play out when 4 of the stocks don't pay dividends.
Now, devil's advocate on this though is, there's the statistic that says that there's $6 trillion sitting in cash and money markets and things like that. Is a 6 or 10 or 15% pullback in NVIDIA the time where that money starts coming alive, right? You're like, oh my God, this is the opportunity I need to get in for this futuristic stock.
If NVIDIA got cut 30%, I would say probably now's the time. Like, I think a 30 or 40%, and that might not come for another year. It might be down to the same price it is now. After a rally is another 50%. I don't think that's probably likely. But I think 30% haircut's probably eventually going to happen. That's probably the time. And that's natural.
Yeah, if you see,
you saw the NASDAQ down almost 30% during 2022.
Yeah, but I mean, if you see the, just the chart on NVIDIA, it's a parabolic line. It's an exponential.
Yeah, it's crazy.
It's crazy.
Really
it's straight up in a short period of time, right? And that's not sustainable. So you have to assume that something needs to correct or happen. It's just timing it, which is not a good.
Did you
it's not a
see
good game
somebody make a forecast about NVIDIA saying it's going to be a $50 trillion company?
50 trillion?
50 trillion by 2030.
What did you say? When did you say Bitcoin was going to be a million or something?
Yeah, and that would put it like at 10 trillion or something like that.
Damn.
No, that would put it at like 20 trillion. But that's replacing gold. That's replacing all the different other asset classes. But NVIDIA being $50 trillion company, basically like 2.5 times U.S. GDP, like no.
Yeah, not realistic.
No.
But yeah, I think everything we've talked about, it's and Tony mentioned it briefly. It's kind of what has to happen. It's like a natural balance type of thing that is really healthy for the market. And we talked a little bit, in a recent episode about planning and not basing a lot of your decisions on like short-term results. This is a classic example of that, right? So if you were piled heavily into those 7 stocks, you probably have done great for the last 12 months. That's not going to continue forever, right? If you're putting new money into the market, you just don't want to put it into what's performed best this year, right? So understanding kind of risk-adjusted return, I think, is a huge part of planning and investing. And I think what's happening now, where we've been tracking and talking about interest rates for 2 years now, and it appears that we finally made enough headway where they're going to start coming down a little bit, and hopefully with maybe a Trump presidency, that is going to kick off a more normal economy, which is what we've been trying to get to for the last 4 years, really.
Well, it is interesting. 10-year Treasury dropped from 5% down to like 4.15 now percent, a little over 4. I've been talking with a lot of clients, people in general, about how that 5% savings account's not going to be 5% for probably much longer. Right. So now you have to balance the act of what's the risk reward of keeping money on sidelines as cash and then deploying that money into more money making areas like the stock market or other areas, right? So there's going to be a balancing act from a risk reward standpoint over the next year. And one of the reasons why even annuities, like you'll see annuities right now, if they're part of your financial plan, like they're paying out pretty good because these annuity companies, insurance companies, invested their
they're locking in these 5%
5% 30-year treasuries because they've used long duration bonds, so they locked in these higher rates, so they're able to pay out more. That's not going to last forever either. So it's just that's kind of where things have been different for about a year than they have been in 25 years with rates higher. Things are going to be a lot different probably in about a year and a half as rates come down. And you have to reposition that, and that's why, again, we've talked about before, why we do plan refreshes to make sure that how it's set up is how it should be. I mean, that doesn't mean we won't get on the phone call and call people if things actually change dramatically, but those review meetings are very helpful in refreshes.
So what do you think? Do we think are we agreeing with the rate cut in September? And do we think there'll be 1, 2, 3? How many more rate cuts, or how many rate cuts, I should say, do we think will happen this year?
All right, Bearish Luke is going to come back out. I think we'll probably be at a 2.5% Fed funds rate by the end of next year.
End of next year, but he's talking this
So
year.
we're basically getting cut. You can call that 8 rate cuts by end of next year.
And how many this year, you think?
2. September, December. 6 next year.
Yep, I was going to say 2 this year. I think 2.5 by the end of next year might be a little low, but it's definitely headed that way. And, you know, we've been talking about it. So I assume you're saying that because you're thinking that we're going to head into like a recessionary or mini recession type of
unemployment will continue to rise. I think Powell, even though he didn't want to say it, Powell hinting in the interview that the job market has normalized and it's no longer like too hot.
Right.
I think he basically was saying, I'm a little concerned about the job market breaking, and we're prepared to cut rates as that continues to happen. So you saw now unemployment jump from like 3.6 to like 4.1 now.
Right.
Like if it gets upwards of 5, like that's when things start to really break. And then when you have a debt economy and you have delinquencies ticking up and people start losing their jobs, and you have a snowball effect. So I think that the Fed's going to have to balance that hard landing, soft landing narrative. I think we're probably going to lean more towards a hard landing than a soft.
Yeah, but the cuts, I believe, is going to spike inflation again.
I'm more worried about deregulation and tariffs from Trump. That is, deregulation is great from a long-term organic growth side. Tariffs aren't necessarily good for that, but those are inflationary. I'm more worried about that.
Yeah, I know that's part of Biden's conversations on this. Is like you're going to raise taxes by jacking up tariffs because you're going to make everything here more expensive. Just trying to keep the jobs here, though. I don't know.
But obviously, the market's not worried about it.
It's a double-edged sword. The only thing is that Powell's target was 2% inflation. I don't think we're ever going to get back there without like some serious issues going on.
Yep.
But I do believe, and he just started talking about it, is the job market. Luke, I think you kind of hit the nail on the head there. If we start getting, north of 4% unemployment, which we're at like 4 right now, right? 4.1. Yeah. Like if we get closer to 5, yeah, like then it's on the table. Because I might say like there's one rate cut, if that. Like I'm going 0 to 1 this year.
Nice.
I don't know if that's bearish or
No,
whatever.
That's bullish.
That is bullish. Yeah, that would be bullish.
I would say 0 to 1, maybe 1.
I think the bond market has been wrong for 2.5 years. I think it's finally going to start to be right.
I agree.
And they're pricing it in
2 this year. I think.
Yeah.
September.
And that they always say they're the smartest people in the room.
They haven't been, but they might be.
Yeah, that has not been true. All right, well, we shall see. It's definitely getting into rate cut season, as they say. So hopefully,
is that what they say?
it's the rate cut season, baby.
It's also earnings season. Maybe we'll have something to talk about next week.
Yep.
Maybe. Just more. Hopefully we don't talk about Trump as much, because hopefully it calms down everything.
Yeah. Hopefully we get some good vibes going. Right, I think we're on.
I think we're on a good path.
Vibes have been increased from the prior.
I've been happier.
Week.
I've been happier mainly because my house is under contract. But that's besides the point.
Congratulations!
Thank you.
Yeah, congrats.
I'm not going to lose my equity when the recession happens.
All right. Well, we'll monitor Luke's position of the sale of his house to see if that was a good move.
Well, but all right. But he said I'm not going to lose any money. It's like, what are you going to invest your money in?
Just gonna be
because that's gonna go up.
I'm just that's for you guys to
bullish.
Find out.
He's bullish.
Yep.
He's selling high and he's gonna invest and it's gonna go up. I love
Costco
it.
puts.
The old 1-2.
No, it's called the money's going into my wedding is what it's called.
Yep.
All right, $100,000 into a wedding. Let's
go. Just about 10. It's actually we're keeping it cheap.
All right.
All right, guys. Well, thanks for listening this week. If you have any questions or comments, hit us up at info@swpconnect.com, and we'll talk to you next time.